a major shift is unfolding at the intersection of Wall Street and blockchain, one that could redefine how ownership works for stocks, dividends, and investor transparency. Last week, Bullish, the crypto exchange behind CoinDesk, announced a $4.2 billion deal to acquire Equiniti, a critical but often invisible player in financial infrastructure, a transfer agent. This isn't just another crypto acquisition. It's a direct move into the core mechanics of corporate equity, aiming to bridge the rigid world of regulated shareholder records with the fluidity of blockchain technology. Most people arrive after the move is obvious and the easy upside is gone. We focus on serious crypto education and high-quality signals before the crowd rushes in, so you can understand the setup earlier and move sooner. If you want that edge, visit the link below now. The real story isn't just the price tag. It's what owning a transfer agent unlocks for the future of stock tokenization. Equiniti manages shareholder registries, processes stock trades, handles dividend distributions, and administers corporate actions for publicly traded companies. By acquiring Equiniti, Bullish gains the authority to record ownership directly, not just issue blockchain-based representations of shares, but anchor them in the official corporate ledger. That distinction is crucial. As Bullish CEO Tom Farley pointed out, most so-called tokenized assets today are little more than digital IOUs. They mimic ownership, but don't change the underlying system. True stock tokenization requires integration at the source, and that's exactly what this acquisition enables. The implications for investors and companies are significant. With real-time tracking of tokenized shares on a blockchain, firms could finally see who owns their stock and for how long, something currently obscured by layers of custodians and intermediaries. For shareholders, this could mean 24/7 stock trading, including weekends and after hours, without waiting for market open. It also opens the door to on-chain dividends, fractional stock tokens, and automated corporate voting. But the deeper transformation lies in data. Companies gain unprecedented visibility into their investor base, which could reshape investor relations, proxy voting, and capital allocation strategies. Yet the path forward isn't without complications. As tokenized equities gain traction, index providers like FTSE Russell face new challenges. Christine Mirzwa, head of digital assets at FTSE, warns that if shares trade simultaneously on traditional exchanges and blockchain networks, market capitalization and liquidity metrics could become distorted. How do you calculate free float when some shares are tokenized and others are? And more critically, can large asset managers include tokenized shares in their funds if they can't independently custody the underlying tokens? These aren't hypothetical concerns, they're immediate hurdles for institutional crypto adoption. The pricing dilemma is equally pressing. If Apple shares trade on a blockchain over the weekend and then reopen on Nasdaq on Monday, which price governs? Discrepancies between on-chain trading and official exchange opens could undermine price discovery. Worse, multiple token variants for the same stock, some with dividend rights, others without, could fragment liquidity and create a dual-track market. This isn't just a technical issue, it's a systemic risk to market integrity. Most people arrive after the move is obvious and the easy upside is gone. We focus on serious crypto education and high-quality signals before the crowd rushes in, so you can understand the setup earlier and move sooner. If you want that edge, visit the link below now. To mitigate regulatory and security risks, many traditional institutions are building closed, permissioned blockchains, walled gardens that limit access while still leveraging distributed ledger benefits. This hybrid approach allows experimentation without full exposure to public networks. Still, the momentum is undeniable. BlackRock, Franklin Templeton, and Apollo have all launched tokenized fund products. Platforms like Robinhood and Kraken are exploring tokenized equities, and Coinbase is pushing real-time settlement using stablecoins. The important part isn't just that stock tokenization is happening, it's that the infrastructure to support it is being built from within the system. Bullish isn't bypassing Wall Street, it's buying a piece of it. But questions remain. Will regulators accept blockchain records as legally binding? Can public blockchains scale to meet institutional demands? And will investors trust a system that blends crypto innovation with traditional finance oversight? The next signal to watch is interoperability. Christine Mirzwa predicts significantly more integration between traditional financial institutions and crypto firms within the next 2 to 3 years. If that materializes, we could see a new era of financial infrastructure, one where stock isn't an experiment, but the standard.